Yeah. My father had saved real estate for 30-something years.
Yep.
He retired 10 years ago.
Oh, okay.
That is a distant cousin.
Anyway.
Oh, okay. Oh, okay. Okay.
So
Not worth it from high school.
I mean, I fish up there all the time. I drive by real estate signs. I'm like, what's the connection to Chip with this?
yeah, that's a cousin.
It's Vermont.
Of course.
Hi, Chip.
How are
Dan.
you?
Good to see you.
Right.
Doesn't even begin to be.
All righty. Why don't we call the meeting back to order? Next item on the agenda is the Empower Quarterly Review. Welcome, Team Empower.
Thank you, John. Good morning, everyone. Gabe DeLeese and along here with Chip Sandville. And I'm in the process of pulling up my presentation that I believe Bill is going to share shortly here. Thank you very much, Bill.
You want to start with exclusive or non-exclusive?
Which is the big one there? Give me 1 second. I apologize. Let me just give me one more second. While I do that, I think just to save time here, everyone, I'm going to ask Chip, so I'm going to just share some really high-level highlights, and then Chip's going to share a field report with, what's going on. But Chip, why don't you give him an update on personnel with Nick joining us up there?
Absolutely. I don't know if everyone knows yet or not. I think we talked about it at the last board meeting. Gillis Owen moved on to other opportunities. He was a rep for us. And we have since hired Nick Marinelli, who I believe is up there. There he is. There's Nick. Nick is a former state employee. He came to us with all of his licenses. Somehow he's lived 2 lifetimes already. Interesting to talk to him. He was in the Air Force for a while. He has a MB. He's doing a great job. He's up and running now. So we're just dividing up the territories. His primary area will be what Susan had before, a lot of the southern half of the state, as well as some of the central and some school districts and Chittenden County. He's going to have Chittenden County as well. So he's going to be busy. A lot of running around for us. We're very, very happy to have him.
Happy to be here. Thanks for the introduction, Chip.
Welcome, Nick. Thank you. Okay. So the 403B, yes, the exclusive, we're going to do a combined for both plans. You'll see combined here. So as of September 30th, before I get into the plans and the numbers themselves, I'll just say real quickly, I think it's important. What we're seeing at Empower, not necessarily representative of Vermont, but what I think it's just important to note that given the government shutdown, we are seeing a high number of participants calling our call center, primarily in the private sector space, our 401k marketplace, but there are a lot of participants that have been calling. We've been seeing an uptick in conversations with, how do I get my money out, loans, withdrawals, and things of that nature. I don't know that that's impacted here. There could be. I did not see the Vermont numbers, but I just wanted to set that out. Hopefully that'll start to calm down now, as we know that hopefully that the shutdown is being resolved, et cetera, so forth. So I just wanted to just level set that real quickly here. As of September 30th, for your 403B plans, we got 100. I'm on page 4.
You got it.
The previous page to that lists all of the plans that are included, the 23 non-exclusive plans. And on page 4, $184.9 million, representing about 2,898 accounts. And we're going to get into kind of what money coming in, money going out, et cetera, so forth. The exclusive portion of that is towards the bottom of the presentation. That's another $43 million for those plans and a list of those plans as well. On page 5, just from a very high level, when we look at the kind of from an executive summary, average account balance is just under $64,000. And we'll get a breakdown in terms of how participants are investing their assets in the middle column there, the My Total Retirement, which is managed accounts, online advice, target dates, asset allocation, which is the Goalmaker asset allocation program, and the do-it-yourself. And as you can see that the majority of participants do their own asset allocation and investing, 40% of that. And when we look at the allocations, equity, 62% of the funds are invested in equities, the majority of your funds. I want to go to other metrics, but I want to go to cash flow on page 8 real quickly here. Year to date for this plan, there was $11.2 million in the plan. million in disbursements year to date, representing in positive net cash flow of about $1.1 million. And you can see there's a breakdown below on a quarter over quarter basis. And the highlights I want to make here, which I'm sure Sarah will cover lately, is especially from the second quarter to the third quarter, we had a very bump, if you will, in equity valuations increasing. Markets have done very well. And if you look towards the bottom line, the change in value as it compared to the fourth quarter of 24 and even into the first quarter of 25, you see minus a million. But we had a positive $12 million in the second quarter and another positive about $10 million in the third quarter as well. So we're seeing a lot of the appreciation is coming from your equities in the plans. Average contribution rate 6.1% participation, and then asset allocation. Now, when we look at I'm going to put some numbers behind on page 13. I'm going to put some numbers behind the investment strategy utilization. Again, there are 141 participants utilizing the paid for fee service of managed accounts, representing about $5.5 million. There's free online advice. People can go in and get a point in time snapshot based on the inputs that they have. So that was 5 individuals, about 853,000. Target dates, 421 of those participants are in a target date strategy representing 27.3 million. Goal maker, 1,100 representing 41 million, etc. And the do-it-yourselfers, the majority, as I said, 1,274 participants represent about $108 million of assets. We also break down on the next page, on page 14, those who are active and those who are separated from service. And it's important to do that because two things we see when people do leave. They'll either start taking a distribution. They can take their money out, but we also see a lot of participants stay in plan. And not only do they stay in plan, but they stay invested in plans based on, as you can see here, the various investment strategies are still being utilized. So that's always wonderful to see that participants still have that advantage of doing that. You can see the numbers breaking down across from there.
Gabe, quick question for you. Explain what Do It For Me is.
Do It For Me is the do it yourself or do it for me.
Well, it's Do It Myself, and then there's Do It For Me. It's on the top on page 13.
Page 13. Okay, so Do It For Me is individuals that utilize a managed account service or advice, so they have it professionally managed. So Chip can speak to that, and we've had these not necessarily with a presentation with boards, but for participants, they go into that level of do they want to do it themselves or they want to do it for me, and then Chip takes them through what's called a best interest tool. Did you want to say anything on that?
Sure.
Go ahead, real
Sure.
quickly. Yeah.
So the do it myself is when they're choosing their own investment options. They're saying, I want 12% here and 18% there and 1% here. And then they do their own rebalancing and, hopefully they do their own rebalancing and things. To help me do it is like the target date funds, goal maker, where they're choosing something that, like you choose a target date fund, you're looking at a projected retirement year, your money goes into that. So they don't have to go in and make all those adjustments. That happens automatically. They're on a track over time to get more conservative. The Do It For Me is, I don't even want to pick that. I want you guys to invest this money, put me in the places that you think make the most sense for me, and you handle it completely for me moving forward. We sit down with people, we go through retirement readiness review, which is one of the things I was going to talk about that's been very, very popular, where we do more of a deep dive than what we've been able to do before. That, when do you want to retire? What are your goals? How does it look, based on what you're doing now? What needs to be changed? And then with the BIP that he's talking about, we can go in even further and look at investment options.
And what's the fee for that?
0.35% per calendar year. It's divided by 4, it comes out quarterly.
0.53?
0.35.
35.
Yep.
How's that dyslexia?
No fee for the goal maker.
No additional fee.
Mr. Chair, we're going to be getting into that with Sarah's presentation.
Okay.
We'll be providing an overview of that service.
Excellent. Thank you.
Later on in the meeting.
I appreciate it.
Thank you. So looking at money that came into the plan here on page 15. Thank you, Bill. So we had before tax contributions of $7.3 million. We had Roth contributions of $788,000, employer contributions. Others, when you see the other column of the 1.9, that represents rollovers into the plan, individuals that have other plans and they want to roll it into their plan. So we had 11.2 million coming in, and you can see on the bottom a month by month, if you will, run rate. In terms of contributions are in the $1 million range, but sometimes they do pop up quite a bit, especially in June. And again, a lot of that had to do with probably rollovers at that time. So you can see all of the various components there. So that's the 11.2 million coming in. And then the next couple pages, break down kind of the individual transactions. Now let's look at money that's going out of the plan, which is on page 17. Of the 10 million, the majority of that are 365 transactions represented separation for service. Now, those are withdrawals that come out of the plan for two reasons. There's the individuals that are taking a ongoing distribution, for example, an installment payment, or people that just have separated and saying, I want to take my money out, roll it over, and just cash me out. So the majority of those 365 were separation for service. There were 39 individuals that received a required minimum distribution up through September 30th. Again, this is through September 30th. So you'll see some of these numbers shift a little in the fourth quarter. And did the various types of distributions. The $1 death, that's a misnomer. There was probably some pennies left in the account. It just never cleared out, but that'll clear itself out. So $10 million came out, and you could see the run rate below month over month. As it relates to distributions, at the end of the year, I do my full year. So for the February report, I'll do what's called a money in motion report. I've shared this once with you before on an annual basis, and that shows you all of the money and where it went. So for all of the separations, where did that money go? Who took an installment? Who rolled it over? Not only who rolled it over, how much was rolled over, and where did it go? What went to Fidelity? What went to this place? What went to that place, etc. So that money in motion report will represent the full year ending December 31st of 25 to be presented in early of 2026.
And just to jump in.
Yes, please.
As you had mentioned once before, a lot of these plans were put in place after teachers had other 403B plans for years and years and years. And so their balance in those other 403B plans sometimes are bigger than what they are with us, and they have more history with them. So we do see some of the rollovers are going back to those previous plans, those 403B plans.
In terms of loans for your plan on page 18 and 19, this is great. I mean, on page, actually it's page 20, there were only 2 new loans in September. And if you look back almost a year now, it's 1 or 2 here or there per month on page 20. But generally speaking, we've got 43 loans, outstanding loans. And I'm sure Sarah will say, wow, for a plan to have that many little loans is fantastic. It's there if they need it, but they're not overly taking advantage of it, which is wonderful. Because loans seems to be the bane of a lot of organizations' issues with participants not saving enough for retirement. So loans, no comments there other than that looks great. The next couple of pages on 22 is just participation in GoalMaker. As you can see on page 22, 38% participation. GoalMaker, this was a product that Sarah's going to dive a little deeper into, but it's an asset allocation tool that was provided to participants through the Prudential, when Prudential took over the plan back in 2018. And as you can see there, 1,400 participants representing almost $50 million in GoalMaker. And then the various participation on page 23, just some demographic data, the different portfolios, conservative, moderate, aggressive, as well as demographic data for you. Very, very standard numbers here. So there's nothing that sticks out that says, what's going on here. On page 25 is going to be a list of all of the individual plans. Page 2 or 3 was a listing of the by contract number, the entities, the actual school entities. Here is some assets assigned to those school entities. And as you can see on page 25, for example, the 475 plan, if you go back to the list, it'll tell you what number that is. But you'll see the number of participants, the balance in that plan, who's eligible, et cetera, so forth, for some statistics for the next 2 pages. John, you had asked a question at the last meeting that I want to respond to. You said, how many teachers in the VSTRS programs are also participating in the state's deferred compensation plan? 168.
Okay.
168. So I wanted to make sure that I got that to you. And then following.
It would be nice to be able to follow that going forward. Again, we're looking for participation. So if that can be incorporated into a index or a chart at the end, so that we see, because if we keep saying we want to increase participation, we want to make sure. Now, some of those participants could be both in the 403B and the 457. So because I am too. But there are school districts that don't allow both. So that number may not be totally accurate. That is a plus X. But it gives us an idea that we have more participants than just the 403B.
Exactly right.
I think there's one that pops into my mind is, I think it's Rutland Northeast, but I'm not sure, where they only offer the 457
Yeah.
through us. And they have
Right.
Following the exclusive, it's going to bleed into the next list of 30 plans, which is the non-exclusive, which goes into this 40 on page 30 of the presentation. Is $44 million in that plan, representing 893. Again, the list of those school districts that fall into what's called the non-exclusive category. These are school districts that offer multiple vendors and that participants can choose from. So again, on a consolidated basis, positive cash flow. Nothing of the number sticks out, but at year end, John, I'm going to be doing an analysis. What's really interesting, a new tool I have available to me now at Empower is some chat information. So I'm able to upload a bunch of the quarterly presentations and ask it to analyze it and give me some results. And I'll be happy to share an executive summary at the February meeting, looking back on 24, not only with Money in Motion, but also, looking back on 25. Not only with Money in Motion, but just some general observations and what we're seeing in activities, whether it be enrollment distributions. What I don't see a lot here is compared to some other 403B plans that we have is, generally speaking, a lot of the old 403B plans or 403B plans or what's called very mature plans, most of the assets are with individuals over the age of 50 that have accumulated that over the years. So what comes into play then is really, different strategies, drawdown strategies and what people are doing. We continue to see a lot of people consolidate their assets. Spouses are working with advisors, families are getting together, consolidating their assets as opposed to managing it in 5 or 6 different places, because some people have various sources of investments. They're narrowing that down to 1 or 2. We're starting to see it a lot, and they're working with professional advisors to do just that. So again, from the numbers perspective, no issue here. Nothing sticks out as concerning that I want to share with you, but more analysis will be coming later next year. So that concludes my portion of this presentation, but I did want to hand it over to Chip to talk a little bit about the field report and what the team is experiencing and how your participants are engaging and what are they saying, what are they doing. So with that, I'll send it over to Chip. Thank you.
So, as part of Nick's training, one of the things he is fortunate or unfortunate enough to do is go out in the field with Brian and I, and we spent a fair amount of time with him in schools as well. And that's been going really well. So he's going to have a fair amount of the school districts because he does have Chittenden County and all of that, and very, very much prepared to take that on. So far this year, the number I wanted to mention, as I said earlier, statewide, we've had about 1,500 individual appointments where we've sat across the table from somebody or virtually. And half of those have been that retirement readiness review. The other half have been either just a quick appointment, a change of beneficiary, change of contribution, or something like that. Enroll, things like that. But half of those have sat down for about 45 minutes to an hour with us to really do a deep dive. And we're definitely seeing we've had 1,072 what we call positive actions from those, and that's where someone made a change. They either diversified properly or they changed their beneficiary. We're getting people when they sit with us to register their accounts, things like that, to get online and update emails and phone numbers and all of that. So that's been going very well. I'm happy with those numbers. What we're hearing from teachers, no surprise, there's a lot of teachers that are ready to retire. We're having a lot of discussions about that. I'd say that's the primary reason that people are meeting with us. People are nervous about the market being high. They're struggling with the cost of things and still trying to save as much as they want to save. But overall, we're feeling that people are doing well and happy and chugging along well. I know we're running out of time here. That's the quick down and dirty. Anybody have any questions?
I would assume most of the meetings are remote still?
Yes, but we're getting more of a combination now. We are in schools more than we have been since COVID. And it's continuing to push for that because that does seem to be, oh, Brian's here. You should, hey, new teacher, you should go talk to Brian. We like that effect that we have when we're on site. Doesn't happen when you have a one-on-one virtual, but yes, still virtual is the best way to get in front of teachers because you can meet them on their schedule.
Yeah.
Especially for these RRRs, these retirement readiness reviews, where it takes some time.
Yep.
You just can't pull them as much as we want to. We can't pull them out of the classroom that long. So, yeah. Any other questions?
When the market's high, how does that discussion go? Like, as you said, there's probably anxiety of, I mean, on the one hand, people are optimistic that, hey, I have a lot of assets, I'm ready to retire. On the second, it sounds like they're cognizant that maybe there's the prices are going to go down sometime, and will they still have enough assets to, I never sit in those meetings. How do they play out? How do you advise?
It depends on where they are in life. If someone is a young teacher or even middle-aged teacher and they're looking at this with, you talk about, you're not in the selling phase, you're in the buying phase. If the market corrects, that's going to be a great opportunity for you to increase your contribution and buy more at the low price. You're not selling tomorrow. So we talked to them about that long-term thing. People who are closer, we talked about appropriate risk. How much risk should you be taking at this point? That's one of the things we can go over with people in that review is where are you, where should you be as far as stocks versus bonds and things like that.
Changing your investment portfolio to adjust for the risk.
Are you on an appropriate track to be in the right situation should something like that happen? Somebody 20 obviously can take a lot more risk than somebody 2 years from retiring. So we get into the details of that, how that would work best for them.
Thank you.
Sure.
Mr. Chairman, if I can, before I hand it over to Sarah here, on my presentation, I apologize, I missed this, on page 51 of the presentation, just to make sure everyone is still aware, with respect to the single deposit investment account, as of September 30th, $20.6 million in the plan, representing 684 participants. And we have about a $1.5 million disbursements, which is on page 52. So you don't have to flash it. So, but it's in part of your presentation towards the very, very end. And again, this continues to be that wasted trust, and it's continuing to operate as we've all seen it. And by the way, my apologies to all of you. To my back, I hope you can hear us. Okay. So I apologize having my back to you. So just wanted to close that out. Are any other questions for Empower that we can address?
Thank you.
Just wanted to raise with the single deposit investment account. I don't know at what point we think about an alternative structure for that.
That's been my ongoing question. And when do we hit the cliff that we say, okay, we got to do something?
Right.
And planning for that going forward.
So I think that's going to be something we're going to be talking about with Sarah and team going forward. It's not anything we have a lot of near-term work we're working on, but just wanted to put a pin on that for future work that I don't think we're at like any kind of sense of immediacy on it, but it's something that over the next year or two, I think we probably want to look at with a little bit more deliberativeness.
Excellent.
I take checks. Of course, I was kidding. Thank you for, on behalf of Empower, thank you all for your opportunity to serve your participants and obviously to serve all of you. Thank you for the visit.
Thank you.
Back to you, Tim and Sarah.
Great. So I think, Chair, next up we have Sarah Bochter here, and I think with colleagues from with Jonathan on from New York to present a few issues. First, starting off with the investment review, and this is going to be the first investment review when we have our investment policy statement and watch list policy. So you'll see some recommendations for watch in here. That'll be a new thing requiring a motion if that's the direction that the board would like to go. And then some additional reviews of a couple of items, the managed accounts, that's my total retirement, Goalmaker, those kind of features that Empower offers. And finally, we had someone flagged for us that our non-exclusive plan does not offer a capital preservation option. It offers something similar, but not precisely that. And so we asked Sarah to do a presentation on sort of the pros and cons and whether or not this board might want to consider adding that option to the non-exclusive plan. So we'll walk through those, and that should take us through till lunch over the course of the next hour. But with that, I'll turn it over to Sarah.
Thank you, Tim, and good afternoon, everyone, or good morning still. All right, so I'll start with the quarterly performance review. And maybe before we jump into the plan update, just a quick capital market update. Of course, everyone's been talking exclusively about the government shutdown last few weeks. But before the shutdown, we were actually talking about other things in the business community when it comes to markets. I think the two biggest topics on everyone's mind have been tariffs and the Federal Reserve, their pace for cutting rates, how and when, how much, and should we be easing more? Are we doing enough? Or are we doing too much? So this is an ongoing debate, and going into December, so the next rate cut will happen in December. This is still as a controversial of a topic as it's always been. As a reminder, the Fed has actually cut rates twice this year, one in September and then again end of last month, bringing that short-term rate down to 4%. This is a big shift, actually, because before that, for almost 2 years now, the Fed has been hiking rates to cool down inflation. Now it's easing again, taking its foot off the brake, if you will. And the goal behind that is, and the Fed has made it perfectly clear, is we don't want to run it hot. We don't want to overheat the economy. We just want to make sure things remain stable. We've seen some softness in the labor market. And with that, we don't want to have rates too high. So that is the reason behind that. The chart on the top right-hand side there shows historical GDP, unemployment, and inflation. You can see here the GDP growth itself has actually dipped. If you remember earlier in this year, this was mostly people front-running tariffs. So a lot of imports were baked into that number. But then obviously, if you look at Q2, it bounced back up to about 4% in the second quarter. So GDP has bounced back strong. And for the third quarter, actually, growth looks positive as a whole. Things are slower but steady. Of course, with the government shutdown, there's expectation that things will slow down a little bit and we'll see some softness in consumer spending. But of course, we haven't seen any October data yet either. So that hasn't come through. So we're kind of driving blind a little bit these days with inflation and jobs growth in terms of October's numbers. Inflation, if you look at the chart, is now hovering around 3%. It has come down significantly from where it was before, but it kind of stalled a little bit over the last couple of years. And that's why it's been highly debated what the Fed should do now, is because are we going to see improvement still in inflation numbers? Is this where we're going to eventually land? Is 3% the new 2 or 2.5% inflation? So that's still TBD. Unemployment, if you look at that, unemployment rates have...
What page is this in the report?
So this is a custom page.
Oh, okay.
I'm just sharing with
All right,
you all.
I'll stop
but
looking then.
Share that after. Happy to share after. I thought it was super helpful, and it is
Yeah, thank you.
as of end of October too.
Okay.
Yeah, I should have mentioned it up top. But yeah, if you look at the unemployment number, so that's the blue rate number, blue line there. Now you see that it's been going up slightly, steadily even since 2022, but only a little bit. So now it's around 4.3%. That number is actually much lower than the 20-year average, which is about 5.7% as of end of October. So despite the increase, we are at a historical low for unemployment still. Of course, we're seeing softness elsewhere in the data. So participation, labor market participation itself is kind of a little soft. And we're not seeing a lot of hiring, but we're also not seeing a lot of firing either, although this has picked up a little bit recently. But in a nutshell, I think consumers are spending, job markets is softening, but it's still solid in general. Of course, with the shutdown, there's data that we're not seeing here, but based on what we could glean from the data we have so far, we've generally, I think we avoided a recession, something that a lot of people were predicting this year. As far as markets are concerned, maybe let's look at this page. It looks at equity markets. Now, what you can see here is the S&P has been doing great. If you didn't know that we had all that fiasco with tariffs earlier in the year, you would think everything's been going smoothly. The S&P was up about 15% as of end of September. As of this morning, I think we're up 16.5% year to date on the S&P. Non-US equities have done so much better. So emerging markets, think Latin America, think Asia. I think they're up double that as of year to date, as of yesterday. On the bond side, however, if you look at the prior page, things have been more choppy. So there has been concerns, you may recall earlier in the year, around the budget deficit, about additional spending, about tariffs, how that will impact inflation going forward, and that have put pressure on the yield curve. So treasury yields went up on the longer end. That is not good for bond markets. But then with rate cuts in September and then October, things looked much better. And year to date, the ag is up 6.8% as of end of October. And bond markets are generally not double digit, but looking pretty strong overall. Now, looking forward, I think we are watching a few different things. We're watching the government shutdown, which is obviously wrapping up now. People have different views on that, but at least on the economic front, this is generally good news for the market. We're watching tariffs. There is a case now, as you may know, in the Supreme Court around the legality of the tariffs themselves. This puts a lot of things into question. Obviously, if the tariffs are overruled, then that will be good for markets. But what does it mean for the government budget? Are we going to refund all those tariffs that were paid? So TBD. Valuation is another concern. A lot of folks are focusing on high tech, AI, all that AI-driven growth in the US market has been very concentrated in a few names that are high, very growth-oriented. And valuations, if you look at that small blue diamond in the top right chart, valuations are record high compared to history. So that's another thing we're watching. And of course, everyone is watching the next Fed meeting in December and what it all means for rates and what it means for future easing, future inflationary path, and labor growth. We'll see how it goes. But overall, I think the story as of now has been one of resilience in the first half of the year. And the third quarter, I think, also was one about relief in the market. Things have moderated. Markets have been going up steadily. And as of now, the economy bent a little bit, but it didn't break despite all the uncertainty. And I think markets were able to just cut through the noise. So hopefully that will continue going forward. But yeah, steady as she goes, I guess, is the message here. Any comments on the market or the economy before we jump into the plan update? All right. So maybe quickly first, Gabe already done a great job covering plan statistics, so I'll swiftly go through that. State of Vermont single deposit investment account. We're showing here assets versus last quarter and performance. Of course, the plan is fully invested in the state of Vermont stable value fund. This is a high quality multi-manager commingled fund, institutional quality. It's run by Mission Square. As you can see, performance has been great, and we'll touch on our general manager update later in the meeting. Moving on to the 403B plan, assets compared to the prior quarter have went up. Allocations, if you look between the different investment tiers, have remained generally steady. If you look at some of the plan stats, Gabe touched on all of that. So just very high level. We see here on the bottom left-hand side chart, we look at cash flows quarter over quarter. Overall, this plan is maybe less mature than some of the others. So you see in participation across age groups. So inflows and outflows generally are offsetting each other. We're not seeing one being dominant. And as Gabe mentioned, year to date, there has been actually modest inflows into the plan. Balances have been growing steadily on the top right-hand side, and that is a lot of it is driven by market gains, as Gabe mentioned. On the bottom right-hand side, we show managed account usage by age cohort, which we think is valuable to track. We'll talk more about that, but you see a lot of enrollment in the younger cohorts. The next page looks at the way we like to look at investment menu usage, which is a bit different from Empower's. The way we like to break it is we also have the same three-tier: do it for me, do it with me, and do it myself. Under the do it for me, we like to look at options that are available to participants who would like the state or would like to use an asset allocation fund or service that the state has vetted and selected on their behalf. And within that, you have 15.6 participants fully invested in the target date funds. And then you have about 40% in Goalmaker and about 5% in managed accounts. Between those three, I think you have about 59% of people in that do it for me bucket. So they would like to delegate that decision fully to either an asset manager like the target date fund or a service. That is pretty in line actually with what we see with other plans. So it's usually in that 60-70% range for plans that have been around for a while. So that is not, of course, that's not different. But of course, what's different is that you have Goalmaker here. So in some other plans, we typically see that usage concentrated in the target date funds, whereas you have more usage of Goalmaker as a replacement of the target date funds. So a lot of those assets are actually going or funneled into the core menu versus a target date series. So that's one difference there. For folks who are preferring to build their own portfolios, you have the core options. You offer folks 10 core menu options, and you have 36% of participants who are fully using the core option on their own to build their own portfolios without the help of Goalmaker. And then another 5.5% who are investing in both the core menu and the target date funds, which is something we see in all plans, nothing very different there. And then finally, for those who want to, build a portfolio from scratch, you have 3 people in the self-directed brokerage window. Majority of assets are in the passive investment options. Actives hold around 15% or so. The most popular option is the S&P Institutional Fund, which is an S&P 500 fund. That is something we see a lot in DC plans. And the second most popular is the S&P International Index Fund. So it's the Vanguard International Index Fund. So that's less common, but passive options are generally very popular in DC plans. And of course, some of that investment is also likely done through Goalmaker. With that, maybe just we can spend a bit more time looking at the managers themselves. This dashboard, which we previewed before, I think at the September meeting, summarizes some of the qualitative and quantitative indicators that we think are important to keep an eye on every quarter. We look at organizational strategy changes. We flag anything that we think is substantial or significant on this page. And of course, our retirements or changes are happening, but a lot of that is part of the course, nothing concerning there. We also flag fees relative to peers. We look at 3- and 5-year performance, so thinking long term here, relative to the benchmark and the ranking relative to peers. And overall, your T. Rowe Price target date funds are doing really great. They are underperforming their benchmark, but this is a custom benchmark that they have created for themselves that tracks their strategic targets. And the underperformance is meant to just show how their tactical positioning has added or detracted from performance. And they have been more conservative recently in their allocation relative to their general long-term targets, but they are one of the most heavy equity-oriented target date glide paths out there. So even though they are more conservative than their target, they have actually outperformed the majority of peers, which is you can see in the ranking here, because generally, as you know, equity markets have been very strong, which really has helped their performance. Your passive options for passive options, our goal is to really track how the manager is, how well the manager is tracking their benchmark. So it's green if they are tracking the benchmark within a reasonable range, but it's red if they are tracking it outside the expected range for their asset class. So as you can see, it's all green across the board for your managers, meaning tracking is within that expected range. And then finally, for the active options, with a handful of exceptions that I'm going to talk about in a bit, active options in the 403B plan and the SDIA have generally done really well, have performed in line with expectations and their objective. And that includes the Lord Abbett Short Duration Fund, which we're going to talk about a little bit more later in the meeting, which is the short duration option that is offered in the non-exclusive plans as the capital preservation option. So this is your safest capital preservation option in the non-exclusive plan. In the exclusive plan, you offer instead the guaranteed long-term fund. And this is a general insurance product, as you know, that is offered by Empower, formerly by Prudential. This cannot be offered in the non-exclusive plans because of constraints and restrictions around cash flows and concerns about cash flows within different platforms. So Empower doesn't make it available on non-exclusive plans. So Lord Abbett Short Duration has been offered instead. But if you look at its performance historically, it has done really great. This is a strategy that invests mostly in investment grade credit, but they have the ability to invest in lower quality bonds as well. So they can invest up to 35% sometimes in higher yielding, what we call junk bonds. And but this has served them well over the long term in terms of performance. But what we're going to be discussing later in the meeting is there value in maybe having a safer option that is like a money market fund option with a shorter duration and a focus on high quality government or treasury bonds or treasury bills to be included in the menu. And so more on that later, but just wanted to flag this manager here for you. With that, I want to pause to see if there are any questions so far before I touch on a few managers that we are recommending for placement on watch for you today.
I do have one question. And I was just kind of wondering if, say I was to, like, about the biases, if that's the right word, or the tendencies between a target date fund versus do it for me versus do it with me. Like, if I was to sit down, just take me, and of course that's one person, but like, would I end up with essentially this? I mean, the target date fund, I understand, will be some mix of equity and fixed income. Am I going to end up in basically the same? If they said, okay, Dan, you're a 60-year-old man, you have this much in assets, your retirement is expected to be X. Will I end up with essentially, and maybe this is a question for Gabe and team, not you, but would you expect I'd end up with, if you look through a target date fund and compared it to the other two, would I end up in the same place, do you think, or would they have different, I'm going to use the word biases, not in a prejudicial way, but just because I don't know how else to describe it.
So I'm happy to take a first step here. So in theory and then in practice. So in theory, yes, there should be differences. Goalmaker is a little bit like a target date fund in that it is based on your age. It will allocate you to a glide path, but on top of that, it offers essentially 3 different glide paths instead of just one, where it also lets you choose a different risk tolerance. So you can say I have lower risk tolerance or more, and it will put you on a lower risk or higher risk glide path. So think of it as 3 versus 1. The allocations will be slightly different. T. Rowe Price is a bit unique. So part of what we're going to do next time is we're going to show you just it will be snapshot in time, but asset allocation for Goalmaker versus the target date funds, and then versus managed accounts, because even managed accounts are a bit different in that they're trying to customize it even further by looking at other profile information that you provide. So do you have other assets? How much are you saving? When do you plan to retire? And they
Can
are.
I interrupt 1 second? I'm sorry. Did you say you're going to kind of take a deeper dive on this in our next meeting? Okay.
Later today
Oh, later today.
Yeah.
Today, I will do that.
on the managed accounts.
Okay, would it make more sense to do it then? I'm sorry to interrupt, sir. I'm just wondering if we're
No,
going to take.
I think for more details, I think really where Sarah is exactly right. It's while you would generally, yes, anticipate being in the same place, I think these 3 options just give you greater levels of customization to say, I can put more of my own values, risk tolerance, other assets into the decision as to how I want to be invested.
Okay, I'm sorry I cut you off. I just was scared if we're going to talk about it in another meeting
yeah.
or later today. I didn't want to sidetrack us.
So no, that's perfect. So yeah, definitely more today and later at the next meeting. But yes, they are supposed to be more customized, and but they are all trying to solve for that same problem. All right, with that, we are flagging for you today a few managers for placement on watch. So we are actually recommending, and this is, comes in the heel of the approval of the investment policy guidelines and the watch list policy that we all approved at the last meeting. For VSTRS, we are recommending, as you can see on the page, Calvert Social Equity Fund, the Impacts Global Environment Fund, and then the State of Vermont Stable Value Fund. Now, just before we jump into the names specifically, just a quick clarifier here. Being on watch doesn't mean that those managers are ones that we expect to recommend their removal at a future meeting. In fact, a lot of the times, many of those managers we put on watch are then removed from watch. It simply means that those managers are under review for one of 2 things. Either there has been significant changes within the firm itself that offers a strategy, or changes within the strategy itself that we think may impact future performance, or that we have seen performance challenges that were persistent for a number of quarters. So it wasn't just that every strategy will underperform every now and then, but we've seen some persistence in the underperformance that we think it warrants taking a closer look. Some of the strategies we may think they would be candidates for removal, but that's not necessarily by default what this placement means. So let's look at those 3 strategies and just talk a little bit about why they are individually on watch.
A quick question. In placing a fund on watch, will RVK notify these funds that they are placed on watch?
So since these are large mutual fund strategies where as opposed to separately managed accounts with specific state mandates, what we typically do in those cases is we would notify the managers, hold individual meetings with the manager. Our manager research team would, to kind of understand what is driving the underperformance. If they were separately managed strategies, we would then, take a closer look at their guidelines, and there may be, changes specific to your plan that would be made. But yeah, general awareness, and then having meetings afterwards is part of the process. And we would then come to you all with updates. Either we think they're doing better, or we saw this additional change that took place that we think is also a flag or a cause of concern. So you will hear, having them on watch means that we will be closely monitoring them and providing you with more updates than we would for other managers.
Excellent. Thank you.
Of course. So first name on watch is the Calvert Equity Fund. This is a strategy that is benchmarked against the most successful benchmark in the U.S. equity market today, which is the Russell 1000 Growth Index. So it is a very challenging benchmark to begin with. But this strategy, which is an ESG strategy, is what we would call not a very benchmark aware strategy. So their allocations can be significantly different from the benchmark at different points in time. And as you know, they have underperformed in 2024 meaningfully and over the calendar year to date. And they have had limited exposure to the mega cap tech stock and communication services over the last few quarters, which really hurt their performance significantly. But they have a very quality focused, very disciplined approach. And they have had a more defensive stance within their portfolio. They have taken steps to manage tracking risk against the benchmark. So we do expect them to rebound. But as you can see here on the page, they are still rated positively by us, meaning that we do still have conviction in their ability to outperform long term. And we think part of that is cyclical, part of that is also due to headwinds facing renewable strategies in general and investments. So no general concern with it as a strategy, but the underperformance has been meaningful, warranting the placement. The second strategy on watch has a similar performance changes as well, which is the the Impacts Global Environment option. So this is a global strategy. It invests in U.S. and international equity. It has a U.S. equity bias, but it also has the same issue. It's not very benchmark aware. So its allocation can be very different from the benchmark. It has also had minimal exposure to the Max 7 and the tech industry. They have adjusted their positioning to mitigate losses, and they are still also rated positively, and we don't have significant concerns with them, but we are watching them closely. And then finally, the State of Vermont Stable Value Fund as well. This is a bit of a different situation. They've actually done really well compared to peers. The strategy's performance, even as of year to date, was great. No concerns with performance, but they have had a lot of changes on the investment team side. Significant turnover this year and then last year as well. And then their parent company, Mission Square Retirement, has also suffered significant outflows on the record keeping side, which led to significant outflows from the investment strategy itself. This raises some concerns for us in terms of how much they're going to invest in the strategy and its team going forward. Will this impact their forward-looking performance, or will they continue to support it as much as they've had in the past? So keeping a close eye on it, but no current immediate concerns with it. So any questions about those strategies? As I said, we'll come to you in the future in the next few months with additional reporting and updates.
And I think this, as I said, follows on our work in adopting the investment policy statement, the watch list policy. In the past, we've kept an eye on these things, and you'll recognize some of these from the ones Joe Fine used to flag for us in our quarterly meetings. But for now, I think what we've been hoping to do is just put a bit more formality to it, and that's why we're recommending that the board pass a motion to put these three investment funds on watch.
Someone comfortable making that motion?
So moved.
Do we have a second?
I'll second that.
Motion to second. Further discussion? All those in favor of putting these three funds on watch, please say aye. Aye. Opposed? Motion carries. Thank you.
Excellent. So as Sarah indicated earlier, more to come. It'll be a bit more formal than in the past, and I think this is a great development actually in our monitoring of our lineup over the long term.
Absolutely. Absolutely.
Can I ask Tim, so let's take the Calvert Fund. Like, as you said, Joe's explained in the past that it's not benchmark aware and will appear like it's underperforming. We've heard that again today. could we just keep it on the watch list indefinitely for that? Or perhaps I should be aware of what the watch list entails. Next year, following year, it's perhaps the same issue, or perhaps the market changes and it starts to outperform. Are we waiting for it to outperform to take it off the watch list? Or can it stay on the watch list for underperforming indefinitely?
So I'll defer to Sarah on this, but I think at the highest level, the watch list isn't meant to be overly prescriptive, but
Okay.
I don't think it's also meant to be a sort of purgatory where funds stay forever. I think the goal is to clear it one way or the other from the watch list eventually, but certain things may take time to, for example, for the Mission Square, right? As a leadership team comes on, as some turmoil in the outfit
Well,
stabilizes.
that's an easier case for me.
Right.
That Mission Square I sort of get. Either they stabilize management and we're comfortable with it, or we're not. Where a fund is not benchmark aware, and that's the reason it's on the watch list. I'm a little bit
Yeah,
less less
I'm happy.
understanding
Yeah,
of
happy
what we do.
to provide more color. So not being benchmark aware for us means performance can be volatile. So many strategies will try to have their performance tracking is within an expected range, a reasonable range. If you look at the tracking error here on the chart, this strategy has historically had that higher tracking error. So that's what that means. Meaning if we see it underperforming by 15 or 20% one year, that shouldn't be an automatic flag for this strategy, whereas it could be for a different strategy. That being said, we do hold it to the same standard as any other strategy in terms of, despite that bumpy ride, it is expected to outperform over the long term. So while may give it a looser leash than some, it doesn't mean that it can stay on watch forever, and it's not expected to do well. It does have a challenging benchmark to outperform, and growth strategies have been under pressure in general. But if it does not outperform long term, I think it should be a discussion for us as a board to think, is this adding value for participants? Would they be better served having their assets elsewhere? And there are a lot of ESG-oriented strategies out there that are able to provide strong performance. Calvert is one we believe in, but they should be able to deliver at some point.
I see. So we're sort of wait for a time in the market where the stars should align for them, their strategy
Right.
in a way. And if it doesn't, if, for example, let's hope it doesn't happen, but if they were to underperform in as part of the cycle where we would expect them to be doing well, then
Exactly.
I see.
Then
Okay.
it's manager specific.
I
Like,
see.
yeah, so sometimes, its style gives us color on what to expect in certain times in the market. So this is a very concentrated market, like we said, and this is not a benchmark aware strategy, meaning it will underperform in some of those markets. So that's not a red flag. But at some point, renewables, they are expected to, rebound. And this is likely to happen soon. And we'll be monitoring those different strategies. And if they are unable to take advantage of those times to recover and bring themselves back significantly above the benchmark to make up for those losses, then the strategy is not managed well to that benchmark.
I think the other thing to note is that this isn't 100% focused on this fund. I think it also it brings into play a bit more of a light onto alternatives that would also meet the board's priorities for this class of option, and say, okay, we have this fund, but there are others, and we're going to look at them a little bit more closely during this period while they're on watch to see if, what we're looking for out of a U.S. equity fund with this type of profile. Maybe there's another one that does a better job. So it's not to put all of the focus on this fund. It's just to say the conversation is going to broaden a little bit in this space during this time.
That makes sense to me. I guess I'm the concern, and I haven't really read I'll confess, I don't really understand our watch. I haven't read our watch list policy, but is there an exposure by just keeping a fund? My fear is you've had something on the watch list. It's on a watch list. You didn't do anything and it's underperformed again. Are we creating?
I think as long as we're actively looking at it, we're having our investment fiduciary present
We've done our
information.
reasonable due diligence. Okay,
This is the exact reason for the policy in this process, is to show that it's, there has been affirmative thought and affirmative action, or a documented reason for no action, if that's the case.
got it. Okay, sorry to belabor
No, I think it's
the
a
point.
great
And
point.
especially now, since this is the first time, we just had the policy, which I think left us more vulnerable not having the policy.
Agree, yeah.
And now, and having the deeper dive and having this discussion protects us even more.
Okay,
And so moving forward, as we get comfortable with this and understand the funds and what our ultimate goal is with our entire portfolio. So members have that flexibility to match what their retirement and investing comfortableness. I think that's the whole package, to make sure that you don't get analysis paralysis. We have excellent funds that meet all the different goals, if SGI, or if you want to do total equity. So it gives it that flexibility. And so far, I think we've done a great job. We'll pat all of our own backs. But I think that these two new policies strengthen it even more.
and so I do read the policy where can I? Was it in our
It
packet?
was in our last
Last packet, the last two packets.
Last two
Last two
Yeah.
packets.
Okay, let me review it again.
yes. And reach out if you have any questions.
Yeah.
Happy to talk about it too offline.
Yeah, and just for the record, the watch list policy also sets a time frame for a 90-day where we are obligated to come to you with an update and a rationale for either removing them from watch or kind of continuing to watch them even further. But there has to be a rationale, there has to be a reason, and this kind of again furthers this oversight process and makes it stronger. All right.
Again, sorry for belaboring.
No, it's,
No,
No, this is a discussion that makes it better.
yeah,
Yeah.
that's the case study for why we're doing it. So.
All right. So if there are no further questions, I think the next agenda item we have is the MEDS account review. If Gabe reminded me actually that the fund change is
Yeah.
going to happen.
Yeah, so Sarah was talking about all the different funds real quickly. Just as a reminder, on December 5th, which will be on the 8th, there's going to be two fund changes about the funds she just discussed, Lord Abbott and Vanguard, lower to a lower share class.
Yep.
So just as a reminder, you'll see that going forward. So
Yeah.
that was
That
it.
was a few board meetings ago.
Yeah.
Where we found the opportunities to save members money by
Correct.
Lower
getting
fees.
access into a lower fee share class.
That's
So
happening on December 8th.
that's going to happen, and our members are going to see benefit.
Very good. Thank you.
Awesome. Thank you, Gabe. All right. So, so as you all may recall, maybe just a quick background why we're doing this now. You all have had a goal maker for a very long time. So obviously it is a good practice to do a periodic review of the service, or take a deeper dive, understand what's happening under the hood and what role it's serving, how it fits within the plan today. Do all the services offered continue to be reasonable and make sense today for the plan? And then something else that has been offered recently was the transition from Prudential to Empower has been the addition. Empower has a bigger suite of advisory services. So with the transition, Vermont turned on the My Total Retirement, a paid managed account service. So obviously, this is an optional for fee feature. As Gabe mentioned earlier, this is a new service, so it has seen a lot of usage. There has been a significant growth in usage, as you would expect, since it's been added to the plan. Currently, around 3% of Vermont participants, or about 5% of assets, and that is as of year-end. Where in the service, I think they are higher now. On the other hand, Goalmaker has about 28% of participants, or 16% of assets. So the average allocation in Goalmaker is a bit lower than the managed account service. So staff, Tim and us feel that it would be good, especially since those are new services that have been added, to also include MTR in that review. Make sure we understand the service, we understand how it's being used, make sure that the right participants are fighting finding the service and using it the right way, that it, fees are competitive, that the value justifies this extra cost. So before we jump into the review, which is a process we already kicked off in Q3, Gabe, Chip, and the entire team have been really an important partner for us in doing that review. We had several meetings to discuss those services, and we shared with them a due diligence questionnaire that they kindly filled out. And it's still an ongoing process, but we felt before we share with you that review results and our key takeaways, that we felt it's important to maybe level set first about what advisory services Vermont offers, how it looks relative to peers, and why it's important to do a review, and what would that entail, what type of things we would typically include in a review of services like these. So with that, maybe we can jump into just take a step back, look at advisory services, what they are. What would you typically see in a DC plan? Managed accounts is the one that everyone talks about, but managed accounts don't exist in a vacuum. They are typically part of a set of different services that a record keeper offer. Plans can offer some of those services, they can offer them all, or maybe choose not to offer any of them. So you see some plans will kind of take a simpler path and stick to offering the investment menu options that you will offer, like the do it for me, do it tier 1 target date funds, tier 2 core options, and potentially a brokerage window, and complement that with education on, offering group workshops or webinars to help participants make those choices. And a lot of plans do that, go that route. But a lot of other plans think that maybe giving them extra help would be good. So for their plan, for their participant base, this is a plan-specific decision. We don't make general recommendations that plans should or should not offer advisory services. So some plans think that advice or financial wellness program will add value to their base, and most record keepers, and like Empower, will let you choose potentially to offer one or all of those services, depending on your needs. In terms of what plan sponsors are saying about the value of those services, I don't think there's wide agreement in the market about which services add the most value. Like I said, this is a plan-specific decision. You see, like in one recent survey that NAGDA did, that this is or plan sponsor did actually. So this is a survey of general plan, public and private DC plans. They found that education and wellness tools were the most valued, but not there's no consensus. 32 and 27%. One-on-one financial planning is also highly valued, and managed account is lower in the list at 8%. And this could be possibly because most plans think of those as helpful for certain part of their participant base, not necessarily something that will be helpful to everyone. In terms of what other plans are doing, nearly half all DC plans, according to different surveys, are offering some form of managed accounts. This is also consistent with what we see in our plan base. If you look at the bottom right, 9% of participants are typically using the service. So this is the percentage of plan participants who are enrolled in the service, 9%. So that's higher than what you have now, which is around 4.5 or 5%. And most plans are offering them as an opt-in service, which is the bottom left chart, as opposed to being the default, although there are plans that offer managed accounts as a default option. This slide shows the marketplace, who are the top players in the managed account space. And as you can see here, this is showing the total AUM, just DC AUM. So as DC assets that each of those providers manage. And what is striking here is that at least as of end of 23, 2/3 of all DC managed account assets nationwide are managed just by Edelman Financial Engines and Morningstar. So that's a very concentrated market. There are, however, new entrants. So this picture is changing rapidly, if you will. Some record keepers like Fidelity have always offered their own proprietary service. Vanguard is going into the space with their own service as well a couple years back. And then others like Goldman Sachs started offering also independent advice offering, but this is a very concentrated space. Quickly, before we jump into Empower, I just wanted to flag that just how much those services can vary from one provider to another. Sometimes if you haven't interacted with those services a lot, you would assume that they all are doing basically the same thing. Portfolio design and rebalancing, which is core of what all those service providers offer. But two things: how they do those investment allocations vary, to your question, and that's important to understand. It's just like with target date funds, you want to understand how they're making those investment allocations, make sure they're sound. You want to do this exact same thing with managed account providers. And then on top of that, there's so much more that some other providers offer that maybe some don't. So services like advice on how much to save, or retirement age, or what to do with your investment, how to draw down your assets, or how to coordinate, with Social Security or other pension income you may have. Those services are not created equal. So some will have higher quality and more sophisticated, advice on those things than others. And then I will also, just to complicate things a little bit, Morningstar itself, its service offering on the Empower platform will be different from Principal's platform. The level of integration, how customized the services, the level of data support that they are getting, and how the role that the record keeper plays in maybe customizing the service to their own platform will vary. So any diligence we do on those services have to happen with coordination with Empower to understand how the Empower platform is offering those services to your participants, because it will be different from others. So I want to pause to see if there are any general questions on that before we jump in. Just looking at the time quickly. Okay, so with that, maybe just looking at Empower service offering specifically. Empower, and I customized this page a little bit when I was looking at it yesterday here. So I wanted to break it in to the three same tiers we were looking at when we looked at the performance report: the do it for me, do it with me, and do it myself. So Empower offers 3 layers of support. If you're looking for full account support and service automatic allocations, Empower MTR will offer this 338 or discretionary investment management of your portfolio, meaning they will be the final. They will have the final word on your asset allocation. You don't have to approve any changes, and they will take full fiduciary responsibility for those allocations, legally speaking. And Empower does that with MTR. They offer MTR through, like I said, Morningstar or Edelman Financial Engine. So they actually make those 2 options available to you, and available to Vermont specifically. The second layer of service is what we call non-discretionary advice. So in this case, Empower think of it as partnering with participants and sharing in that responsibility. So they will provide one-time personalized recommendations to participants. This can happen through those one-on-one appointments that CHIP has with participants, or they can happen when you use online advice tools that you have on the website and get a recommendation and choose to implement it. So you have to make that approval first. And they can also happen when you call the call center and speak to a retirement plan advisor. They can also provide you with a recommendation that you can then approve. So in those cases, Empower assumes a fiduciary role here and have a responsibility as a 321 advisor. but it is a co-fiduciary role, not like with the 338 where they are taking full responsibility. And then the third tier of services is education. So that is a non-fiduciary service where Empower will offer education through its learning center. It offers access to calculators, resources that participants can use on their own, and it doesn't generate any recommendations. And you see, I haven't mentioned GoalMaker yet. GoalMaker is kind of a bit nuanced here, because technically GoalMaker is, as an asset allocation tool, is considered education, meaning neither Empower nor Morningstar will take on any fiduciary role for the GoalMaker service itself. The plan fiduciary is responsible for reviewing and approving all the model portfolios before they get implemented, whenever they get implemented. So they are generally, Empower maintains those portfolios, Morningstar designs them, but they are considered education, meaning there isn't that same level of fiduciary responsibility you get with those other services.
Sorry, you said 3.2, maybe I should know that 3.2.1 and 3.2.8, is that ERISA sections?
These are ERISA sections.
Okay.
So yeah, that's 338.
3.3.8, 3.2. Okay.
So the 338 is when they have full discretionary authority on
Okay.
allocations, and they can make any changes they want without getting any explicit approval.
So they have the most rigorous legal
Exactly.
standards to comply with. I got you. Okay.
Yeah.
Thank you.
So GoalMaker, so that's why I did want to include GoalMaker here under asset allocation services, since it's technically a do it for me. It is something you put your money in and it will make automatic changes, but it also kind of falls under education. So I can see it under both buckets, but so it's important to be aware of those nuances there with the support. And then and the reason they can do that, by the way, is because GoalMaker is not offered for a fee. So it's a free service. If it was a recommendation for a fee, then it has to be a 338 or 321 service. So quickly, how are we doing on time? I think
we're moving a little bit. I think we want to focus on where some of the data about where Empower sits in the pack.
Thank you. So maybe just jumping quickly to where, so as I said, Empower offers, so here maybe let's look here quickly. I know we have 10 minutes left. So we benchmark your usage against and balances against our peers. We do an annual DC fee benchmarking for all our participants. And as I said, about half our plans also offer managed accounts, but these are different providers with different record keepers. And what you'll see here is in terms of enrollment, so the percentage of participants using the service, we typically see it in anywhere between 3 to 5% typically, but it can go all the way up to 25% of participants in a plan using the service. So your current range is in the 4 or 5% range is actually in line with our median peer. And in terms of balances, the average balance here is a bit lower than what we typically see. So $24,000 at least as of year end is a bit lower, and this could be driven by having higher enrollment by younger folks who still have those lower balances. But in terms of fees at the right-hand side, fees are generally competitive and in line with our median peer. Now, plans in our universe typically pay the tiered fee structure. So your fees will vary depending on how much assets you have in the service, whereas your fees are flat. So that's actually a good thing in your case because balances are low. So if those participants were assessed the tier structure, they would probably be paying maybe 45%, 45 basis points, I'm sorry, instead of 35. Well, of course, on the other extent, if balances were much higher, then it would look different. So our goal from the review will be basically to make sure that the value justifies those fees, that the enrollments and people who are using the service are benefiting from the service. And what we will typically want to review is we look at who is using the service, who is enrolling in the service. So that's a demographic review. We also look at the enrollment process itself. This sometimes helps us understand how folks are using the service. And these are some of the questions Gabe and team helped us with already. And we also look at, like I said, investment approach and recommendations for the service, not just for what their average allocations are, but we also give Empower certain profiles to fill out for us for certain specific situations to understand how they change their allocations for different participant profiles. And then we look at engagement, because in managed account services, engaging participants after they enroll is very important to understand how they are using the service and make sure that they keep their profile updated, because a customized service won't be as useful if you're not customizing it for your own personal needs. So understanding that engagement process is important. And of course, understanding all the other services that are being offered will be part of the review as well. So maybe let's bring it home. Just to emphasize that your job as a board is not to micromanage those participant accounts, look at every portfolio, see how it's allocated. It's to ensure that the structure of the service makes sense, and that the service is fair and competitive, and it's targeting the right people. So that means, doing those periodic reviews. It means monitoring usage and outcomes periodically, and documenting that review and documenting those results. And sometimes those reviews will lead to maybe recommendations for change. And there are things that can be changed, and we can collaborate with Empower on maybe fine-tuning some of the ways participants interact with the service and how they use it. So more to come on that and at the next, at a future meeting.
And I think we've had, at least at the staff and Empower level, I think we've had a good conversation on this. There were times when we saw some of the, enrollment materials have what we thought was maybe too much of a focus on MTR. And so they've responded when we, asked to customize it and maybe take something down. We've had that good conversation. And so the point of this really was to make sure that the board had a solid understanding of what these programs are, how they're being offered, who's using them, and then more to come on it. But I appreciate you putting this together. I think it helps kind of give that context as to what these are. And if anyone has any questions.
I guess I'd still be curious for a later date and I don't know, this may be beyond the scope, but again, if you had a 60-year-old man who was planning on retiring at 65 with this number of assets, which options, are there biases to the options? Maybe that's totally beyond our scope and is irrelevant, but I'm curious.
We actually shared some profiles, some for retirees and some for younger folks with Empower, and asked specifically for that. Can you provide us for this menu what the recommendations would be for with Goalmaker, with MTR, to kind of get at that question specifically.
Okay, well, I'd be curious to see what the results are. Okay, awesome. Looking forward to it. It's looking forward to it. Sounds really interesting. Thank you.
And thanks to Empower for all their support with that process.
John Vio?
Then with the investments that we're looking at and all that, that's for the 403B. So does the 457 have the same? Everything pretty much the same in there, or
the offering?
The same offerings, like the goal maker and like the same investment choices and all that.
The same
offerings, different investment choices.
By us looking at the 403B, we're essentially looking at the 457 as well. Or?
Well, the 457 is run by the state, whereas we're the fiduciaries for the 403B.
But I think to the point that Goalmaker, things like Goalmaker, NPR, all those features are similar and they're going to be similar. It might have a different, global equity fund in one versus the other, but conceptually, the structure and those features are going to be similar.
Yeah. So they all use the core options, whatever the core options are for the plan are what's getting used by those services. So to the extent the menu is similar, the allocations will be similar, but they're all informed by what's on the menu itself.
So I could tell my members, because we have the choice of the 457 or the 403B, that, you know, by looking at the 403B, I've essentially kind of examined the 457 as well.
Yeah, so we are doing this review on behalf of all the supplemental plans, and we are getting data from Empower for all of them. So we are doing them all essentially, and our recommendation, to the extent there are differences, we don't expect to have, to the extent there are differences, they may have to do with how different plans interact with the Empower platform or interact with retirement plan advisors. So that's where we're seeing differences between plans. But there are no differences in how managed accounts services are offered or used. Any differences there will be just based on what's in the menu.
And then would that be the reason for the difference in the fees, the 0.34 to the 0.09%?
So that was actually that is those differences in fees are driven by we asked Empower to share with us assets at year end and number of and the fees at year end and assets at year end. So the differences are just basically just dividing those two, the fees by assets. So plans that saw more enrollment have that number look lower, you know, at year end, because it's looking at just snapshot at year end of how many assets are in the plan at year end, basically. So all of them have the same, all of them have that same 35 basis point fee across.
Even the 457?
Even the 457.
Yeah.
This is just a snapshot in time. So with more enrollment, you have more assets at year end. So the fees that were collected throughout the year, if you divide them by that assets at year end, it looks like the fees are lower. So actual fees seem lower.
Yeah, but it's the same price.
But it's the same
for all
price.
of them. Yeah.
It's the same price.
Price aside, I want to get to the core of your question because it's so important with various boards. You've got two programs, a 403B, which follows the 403B IRS guidelines, and a 457. For example, 457 doesn't have loans. They could, but they don't have a loan provision. Whereas, you know, 403B you do. All of the, as Tim mentioned, all of the features are the same, but it's the underlying investment options that are slightly different based on when they were selected and set up. Okay. But what do you tell participants? What do you tell participants? Look, these are supplemental plans. Look at both, see which one fits you, but the services are identical. It's probably the best way to say it.
Yeah.
So it's really a matter of choice.
Well, and the 403B versus the 457 also has different tax.
Exactly.
That's the key in my little brain. The key is the tax differential between the 457 and the 403B in terms of when you can withdraw and those types of
Those are the
things.
IRS differences.
The IRS differences many times give other options and advantages, depending on what you think personally as an advantage with a 457 versus a 403B, or do both, because there are some IRS advantages and disadvantages.
Two major differences: loans versus no loans, and the other one is what's called a 10% penalty. 457 never has it. 403B does. If you're under 59 and a half and you leave, you can be subject to a 10% penalty.
Yeah.
Again, there's tax. To the chairman's point, there's tax consequences. There could be some program features, but they follow the IRS guidelines. But the engine, probably the chassis, is the same across the board. It's probably the best way to say it.
Yeah, no, that's
One other popular difference is,
Because Chip, you talk to participants all the time, and I'm sure you get that question.
absolutely. Not all 403B plans offer a Roth option,
Yeah.
but all 457B plans within the Vermont plans do. So if somebody wanted to take advantage of the Roth, some 403B options do offer the Roth. It depends on how it was set up in each school district, because they each get to choose their own rules and things. So that's one reason we see a lot of people going with 457.
Highly recommend you, for participants that ask you those questions. It's important for you as a board to understand, but have make an appointment with Chip and team.
Right.
So they can go through the differences and the nuances and what.
Yeah, because that's an excellent point, because our school district in their district plan decided to go with the 457 instead of opening the Roth for the Roth 403B in the 4B plan. They just said, let's add the 457, then we got the best of both worlds.
And school districts are the only group in Vermont that can do they can do a maximum contribution to the 403B plan and the 457 plan.
Provided you can afford it.
Right, I was gonna
You don't
say.
need groceries. You know,
Right.
Make sure we talk about affordability.
Well, yeah, and we sometimes see plans that we work with where we collaborate with them on putting together just this high level snapshot of these are the plans that are available to you. These are the differences, main features. Because yeah, the typical participant is just not going to be aware what those differences are, and they'll be probably wondering about those same things, which one plan can I
And you'll
join?
get questions.
Yeah, so
Which
maybe
which is
putting
better? Which
together-
should I invest?
Yeah,
Talk to someone.
And we,
Yeah.
that's what we're here.
That's the key.
good.
Excellent. I mean, this is exactly, especially as we're transitioning from Prudential to Empower. You know, there's some changes already, and to be able to really start understanding, I'll speak for myself, truly understanding all of the options and what are offered. We know what the fees were, but now really getting into it to see, as you said, Morningstar, and fiduciary responsibility. That was enlightening for me today. I didn't understand. And you hear these services, but what are the fiduciary responsibilities within those services, and understanding what a target date fund truly does. So this has been very educational. Thank you.
More to come.
Yes.
Yeah, I'm looking, I mean, I think to follow up on your point, John, I mean, if there's, how much do you pay to be, one service is free, but you're not a fiduciary, but you don't get but it's not an ERISA fiduciary responsibility, or relationship, I should say. Another service you pay for, but, and you get, then you're an ERISA fiduciary. I don't,
Yeah.
it'd be helpful to hear.
Yeah.
How do you quantify, I mean, in some ways, how do you quantify that? I don't.
Participants' comfort.
Well,
Right,
and there's a lot of inputs. And Sarah will get in. She said she's.
Yeah.
you guys
Yeah,
gotta hear
I'm looking
both
forward,
out.
I'm looking forward to
To
it.
give you a really high level, just to level set here. Right, you can go online advice, get some information and do your own thing. Goal makers, 2 points, 2 data points. What's your risk tolerance and time horizon? Right, target date, what's your time horizon? That's it. When you get into a 338 or a managed account type service that you're paying for, you're gonna get 5 or 6 inputs.
I see.
Outside income, spousal income, drawdown strategy. What are your taxes? What are your It's a different conversation.
Got it.
It's a difference between a 10-minute, where do I enroll, versus an hour presentation, unique, tailored to your needs based on the inputs you provide. So that's what changes the service. And again, you have to ultimately determine, is the cost commensurate with the value that I'm receiving? Right.
And that's kind of our objective over the course of this
Right.
past year in the relationship with RBK as well, to help us raise up these issues. And the reason why we have board governance structures is for you folks to apply value judgments and, how you think our members will be best served. But our job as staff is to kind of really tee up the background, the information, the choices, and, have you understand them and then make them. So that's that's the whole reason why, we keep having Sarah come back with another educational
Great.
presentation, and then that usually will follow into something where there may be a decision point.
Yeah, this is critical. It's fiduciary. Really, really good.
Mr. Chair, we are over time, and I know there are probably municipal board members arriving for the
Waiting
lunch.
to eat.
I
Yes.
wonder if the last topic, capital preservation options, if we might want to push that to
I think that'd be appropriate.
I
Yeah.
think a subsequent meeting. I think we will continue to do work to look at this issue about whether or not we want to add another fund.
Yep.
But I think it might.
And that'll be good because you'll have more time with the watch list, and then we'll have more data, and then we can see if we can match the funds. Yeah, that makes perfect sense for our next meeting. All righty. We'll move to any other business before the board.
I think the only thing, and I plan to ask all the boards this, is I think I like the 2 in-person meeting cadence a year. I just wanted to throw it to board members as we generally feeling that's reasonable, more or less.
I mean, I have a return to office now, so if it's the same day, I mean, I'm happy to be here. It's more fun to be here.
And you get a lunch.
And maybe I'll get a lunch out of it.
Yeah.
But, it depends when.
Oh, sure. We'll schedule appropriately
I really like our 3:30 meetings, so, because those fit in really nicely.
with the school day.
Yeah,
Yeah, you don't have to miss a day.
Obviously, I defer to what works best for you guys.
Once or twice a year would be all right for this.
Yeah. Okay.
Used to be monthly.
Used to be monthly, yeah.
That's-
My kids would say, "You're leaving again?" All righty.
Great, thank you.
All right. Do we have a motion to adjourn?
So moved.
Second?
Second.
All right.
Yeah.
All those in favor of adjournment, please say aye.
Aye.
Let's have some lunch. Excellent meeting. Thank you so much for everybody's involvement today.
And thanks to everyone who came and
The whole-
presented.
I got all the seconds.
Yeah,
collected on your-
you're getting ready for Thanksgiving. All the seconds.